You already understand the stock market. You just don't know it yet. And I'm going to prove it to you in the next 60 seconds using a pizza shop. This is episode 2 of Trovest Academy. In episode 1, we learned that inflation silently destroys your wealth, and that investing is the only proven way to fight back. Today, we're answering the most fundamental question in all of investing. What is the stock market actually? By the end of this episode, you'll understand it better than most people who've been investing for years. Here's the pizza shop analogy that will change how you think about stocks forever. You and 3 friends decide to open a pizza shop together. You each put in $25,000, $100,000 total. That means each of you owns 25% of the business. Your 25%, those are your shares. Now the business is worth $100,000. Your 25%, your shares, are worth $25,000. Simple so far, right? You own a piece of a business. That piece has a value based on what the whole business is worth. Now imagine the pizza shop does really well. Great reviews, long lines, you open a second location. The business is now worth $200,000. Your 25%, it's now worth $50,000. You doubled your money. And here's the key insight. You didn't do anything extra. You didn't work harder. You didn't put in more money. The business grew, and because you owned a piece of it, your wealth grew with it. That is investing in stocks. That's the entire concept. You buy a piece of a business, and if that business grows, your piece becomes more valuable. Now replace the pizza shop with Apple. Apple is a real company. It designs iPhones, Macs, iPads, AirPods. It has about 164,000 employees. Tim Cook is the CEO. It's headquartered in Cupertino, California. When you buy a share of Apple stock, you are literally buying a tiny ownership stake in that company. You own a piece of Apple, just like you owned a piece of the pizza shop. If Apple's business grows, if they sell more iPhones, launch new products, expand their services, the company becomes more valuable, and your shares become more valuable. A stock is not a number on a screen. A stock is not a line going up and down. A stock is ownership in a real business. So if stocks are ownership in businesses, where do you actually buy and sell them? Stock exchanges. Think of a stock exchange like eBay, but for stocks. It's a marketplace where buyers and sellers come together. If you want to buy Apple stock, you don't call up Apple and ask. You go to the exchange where Apple's shares are traded, and you buy from someone who's selling. The 2 biggest exchanges in the United States are the New York Stock Exchange, the NYSE, and the NASDAQ. The NYSE has been around since 1792, when a group of traders literally signed an agreement under a buttonwood tree on Wall Street. The NASDAQ launched in 1971 as the world's first electronic stock market. Apple trades on the NASDAQ. Today, it's all electronic. You tap a button on your phone, and in milliseconds, the exchange matches you with a seller. Done. Here's something that confuses a lot of people. How is a stock's price actually determined? The answer is surprisingly simple: supply and demand. Just like anything else in economics. If more people want to buy a stock than sell it, the price goes up. More buyers than sellers, price rises. If more people want to sell than buy, the price goes down. More sellers than buyers, price falls. That's it. That's how stock prices move. Every single price movement you've ever seen on a chart comes down to this balance between buyers and sellers. Now, what causes people to want to buy or sell? 5 main things. Earnings. Is the company making more money? Growth. Is the business expanding? News. Did something significant happen? Sentiment. How are people feeling about the market? And the broader economy. Are interest rates changing? Is unemployment rising or falling? All of these shift the balance between buyers and sellers. Let's see this in action with Apple. Over the past year, Apple's stock has traded between about $169 per share at its lowest and about $289 at its highest. Right now, it's around $259. When Apple reports strong earnings, more iPhones sold than expected, services revenue growing, buyers flood in because the business looks stronger. The price goes up. When there's a broad market sell-off, maybe fears about the economy, Sellers rush out. The price goes down. Every single price movement has a reason. It's always people making decisions based on new information. When you understand that, the market stops feeling random and starts making sense. The US stock market isn't open 24 hours. Regular trading hours are 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. That's when the vast majority of trading happens. There's also pre-market trading from 4 a.m. to 9:30 a.m. and after-hours trading from 4 p.m. to 8 p.m. But here's my advice. If you're a beginner, stick to regular hours. Pre-market and after-hours have less volume, which means bigger price swings and worse prices. The regular session is where the real action is, and it's the safest place for new investors to execute trades. There are three types of players in the stock market. Understanding who they are helps you understand how it all works. First, retail investors. That's you and me. Individual people buying and selling stocks through a brokerage app. About half of American adults own stocks in some form. Second, institutional investors. These are the heavyweights: mutual funds, pension funds, hedge funds, insurance companies. They manage trillions of dollars, and their trades can actually move stock prices. When Vanguard buys 1 million shares of something, the market feels it. Third, market makers. These are the middlemen you never see. Their job is to always be willing to buy and sell, which keeps the market liquid. When you tap buy on your phone and the trade executes in milliseconds, that's a market maker on the other side making it happen. Institutions control about 80% of the market. But here's the good news. As a retail investor today, you have access to the same information and the same markets they do. That wasn't true 20 years ago. When the news says the market was up 2% today, what does that actually mean? Which market? They're usually talking about one of three indices, the S&P 500. This tracks the 500 largest publicly traded companies in America. Apple, Microsoft, Amazon, Google, they're all in here. When people say the market, they almost always mean the S&P 500. It's the benchmark. The Dow Jones Industrial Average. This is the oldest index, created in 1896. It only tracks 30 companies, the big blue chips. It's famous, but it's actually a pretty limited view of the market because 30 companies out of thousands isn't much. The NASDAQ Composite. This includes all 3,000 plus stocks listed on the NASDAQ exchange. Because the biggest tech companies are listed there, it's often called the tech index. More volatile than the S&P, but often higher growth. Here's the important thing. These indices are not investments. They're scorecards. They measure how a group of stocks is performing collectively. Think of them like the score of a basketball game. The score tells you how the team is doing, but you can't buy the score. You've probably heard the terms bull market and bear market. Here's what they actually mean. A bull market is when stock prices are rising over a sustained period. Think of a bull thrusting its horns upward. Investor confidence is high, the economy is generally growing, and people are optimistic. The average bull market lasts about 5.5 years and gains about 180%. A bear market is when stock prices fall 20% or more from their recent peak. Think of a bear swiping its paw downward. Fear and pessimism take over. The average bear market lasts about a year and drops about 36%. Here's the critical thing to understand. Since 1928, there have been 27 bull markets and 26 bear markets. They alternate. That's how markets work. And every single bear market has eventually ended and been followed by a new bull market that took prices higher than before. Both are normal. Both are expected. Neither should scare you. There are two ways stocks make you money, and most beginners only know about one of them. The first is price appreciation. You buy a stock at one price, the business grows, the stock price goes up, and if you sell, you pocket the difference. Buy at 100, sell at 200, you made $100. Simple. The second is dividends. Some companies take a portion of their profits and pay it directly to shareholders as cash. Just for owning the stock, you receive money, usually every quarter. Think of it like rent. You own a piece of a business, and that business pays you for being an owner. Apple, for example, pays a dividend. Every quarter, Apple sends cash to every single person who owns its stock. And here's the best part. You can get both at the same time. The stock price goes up and you collect dividends along the way. Let me show you what this looks like in practice on the Trovest platform. Here's Apple's company profile. Right at the top, Apple Inc., ticker symbol AAPL, traded on the NASDAQ exchange. Current share price around $259. Now look at the details. Sector, technology. Industry, consumer electronics. CEO, Timothy D. Cook. Employees, 164,000 people. Founded in 1976. Went public in December 1980. This is what I mean when I say a stock is ownership in a real business. 164,000 people wake up every day and go to work at this company. They design iPhones, build Macs, run the App Store, create Apple Music and Apple TV+. When you buy a share of Apple, you're not buying a line on a chart. You're buying a tiny piece of all of that. And on Trovest, you can see all of this, the financials, the growth metrics, the scoring, so you can make informed decisions about which businesses deserve your money. Before we wrap up, let me kill 4 myths that stop people from investing. Myth 1, you need thousands of dollars to start. Reality, most brokerages now let you buy fractional shares. You can buy $5 worth of Apple stock. You don't need to afford a full share. Myth 2, the stock market is just gambling. Reality, gambling is random chance. Investing is buying ownership in real businesses that generate real profits. When you analyze a company's financials and make an informed decision, that's the opposite of gambling. Myth 3, you need to watch the market every day. Reality, the best investors in history check their portfolios infrequently. Time in the market beats timing the market, every time. Myth 4, you need to be a math genius. Reality, you need basic arithmetic. Add, subtract, multiply, divide. That's it. And tools like Trovest handle the complex analysis for you automatically. 3 takeaways from this episode. Number 1, stocks are ownership in real businesses. When you buy a share, you own a piece of a company with real employees, real products, and real profits. Never forget that. Number 2, prices move on supply and demand. More buyers than sellers, price goes up. More sellers than buyers, price goes down. What drives that demand? Earnings, growth, news, sentiment, and the economy. Number 3, markets go up and down. Bull markets and bear markets are both completely normal. The market has always recovered, always. Understanding what you own is the first step to building real wealth. In the next episode, we're covering every investment type you need to know. Stocks, bonds, ETFs, mutual funds, index funds, REITs, options, commodities, and crypto. There are 9 ways to invest your money. Most people only know 2. After episode 3, you'll know all of them. Hit subscribe so you don't miss it. And if you want to start exploring real company data, like the Apple profile we just looked at, check out Trovest. Links in the description. See you in episode 3.